Hello, this is Rachel from Kalkine Media. Please subscribe to our channel and press the bell icon to get notifications for our latest videos. What is Wall Street Journal Prime Rate? Well, Wall Street Journal Prime Rate, or Prime Landing Rate, is a benchmark rate published by the Wall Street Journal based on a market survey. It's computed by taking into average the various prime rates that the 10 biggest banks of the US charge from their best credit to quality customers. It's the charge on relatively short-term maturity loans. The journal surveys the big banks, and when data changes, the journal changes its rate, which stands effective from the publication date. As described on the Third Amendment to Credit Agreement on the Securities and Exchange Commission portal, prime rate is defined as a per annum rate of interest equal to the prime rate for any day, as frequently put out in the money rates column of the Wall Street Journal. It also states that if for any reason the rate is not available, it shall be reasonably established by lenders. The rate is to change effective from the date on which any change is published in the journal or as established by the lender, whichever is fitting. It is to be considered only as reference rate and not as a representation of the lowest or best rate charged to any borrower or customer in reality. In summary, the Wall Street Journal Prime Rate is a benchmark rate computed by the Wall Street Journal. It is used by US banks as a reference rate for variable interest rate loan products. It holds importance not just for banks or companies, but also for retail banking customers. So how is the Wall Street Journal Prime Rate used? Well, the WSJ Prime Rate is commonly accepted and tailed across the banking and financing industry. It's a vital index used by banks to set rates on various customer loan products. The variable credit rates in banking products follow up and down movements of the prime rate. Generally, it is the lowest rate banks charge to their credit-worthy customers and other banks. Banks use the prime rate as a standard rate for variable credit products. Bank products applying the prime rate directly or indirectly include mortgages, home loans, credit cards, and auto loans. Products with an indexed interest rate also quote interest based on WSJ Prime Rate, with a spread based upon the borrower's credit summary. Credit card issuers pin variable rate cards' interest to the prime rate, with additional margin decided by banks according to the risk profile of a consumer or his credibility to the bank. In a variable rate credit loan, the margin doesn't change over the life of the loan. However, the variable portion is attuned to the change in the underlying index rate. This brings a lot of difference for the borrowing parties. As WSJ Prime Rate is available publicly, borrowers prefer products based on the WSJ Prime Rate. Other similar indexes used by the industry are LIBOR and US Treasury Rate. For example, take a credit card issued by Citigroup to an American borrower. The credit card balance is variable based on an annual percentage rate. The borrower's margin supposes 10% plus the index rate. Now, if the index rate here is WSJ Prime Rate, then if WS Prime Rate is 4%, the interest rate charged to the cardholder will be 14%. If the WSJ Prime Rate increases to 5%, the credit card interest rate would go up to 15%. If the WSJ Prime Rate decreases to 3%, the credit card holder will be charged 13% by the Citigroup. Various other indices are also quoting as prime rate, but WSJ Prime Rate is the most used one. It generally matches its movement up or down with fluctuations in the Fed's fund rates. Fed funds rates are set by the Federal Open Market Committee. It is affected by the cost of borrowing of banks, passed on to borrowers as the interest rate on loans. The WSJ Prime Rate does not change often. Fluctuations are mostly followed by variation in Fed funds rate. To obtain the current and historical rates, you can visit the Market Data Center section of the Wall Street Journal website. How is the WSJ Prime Rate important in daily life? Well, WSJ Prime Rate is not just important to banks, financing organizations, economists, or the readers of the Wall Street Journal, but does hold importance in everyday life. This is because it is a key pointer to the cost of end-user borrowing. Any retail loan in the US having a variable interest is affected by the prime rate issued in WSJ. This is from credit cards held by more than half the US population to adjustable rate mortgages on property. All are impacted by prime rate fluctuations. If WSJ prime rate goes up, consumer loan interest rates go up too. Credit customers' borrowing costs are a result of their credit scores. If one has an excellent credit history, he or she will be charged a lower margin over the prime rate. Exceptionally good credit scores may also qualify for prime rate lending, having no additional charges above the prime rate. But if a consumer's credit score is low, he or she shall have to pay a higher spread on even small-size borrowings. Therefore, if the prime rate moves up, the costs of borrowing shall shoot up significantly in some cases. The costs then will be considerably high for people with lower credit scores compared to customers with better credit rating. It can also affect the demand and supply of credit in the market. If variable loans, often taken for short-term needs, become costlier, their demand shall fall. This may in turn result in the closing of various bank credit schemes. Therefore, the WSJ prime rate holds important for economic balance in the US. How does the market react to changes in WSJ prime rate? Well, daily monitoring of WSJ prime rate is not needed, but depending on financial needs, one may pay attention to its recent movements. Depending on the prevailing WSJ prime rate, one may purposefully downsize debt payments, delay any big acquisitions, shift funds from fixed to variable interest paying deposits, consider refinancing options, debt consolidation, loan repayment, or balance transfers. The prime rate has affected the US economy in the 2008 financial crisis that was caused by mortgaged loans and recently causing economic chaos amidst the pandemic. Small borrowers to big or corporations are affected by it. The smallest change in the prime rate can therefore bring big economic shifts. If you like this information, please like, share and comment on this video and subscribe to our YouTube channel. Press the bell icon for notifications for all our latest videos. For regular updates and information, log on to our website, kalkinemedia.com. I'm Rachel Jones, signing off for Kalkine Media.